So welcome to this session. It's a continuation of part one of earnings per share. We are going to look at IAS 33, which looks at earnings per share. So in the previous session, we concentrated on what we looked at basic earnings per share. And today we are going to focus on diluted earnings per share. Now, in the last session, we looked at the objective of earnings per share, or the objective of IAS 33, which we said was to prescribe the accounting treatment of EPS, to prescribe accounting treatment of EPS. And we said that under the scope of IAS 33, we said IAS 33 applies to entities whose ordinary shares are traded in the stock exchange market or the securities exchange market. So that was the scope of IAS 33. And then we defined EPS as the amount of earnings for outstanding stock. That is profit attributable to ordinary shares divided by the weighted average number of ordinary shares. And then we defined ordinary shares as equity instruments that are subordinate to all other classes of equity instruments. That is equity instruments that are paid last when we are paying dividends. And then we also define potential ordinary shares as a financial instrument or other contract that may entitle its holders to ordinary shares. So a potential ordinary share is currently a financial instrument which will be converted in future into ordinary shares. So for it to be potential, it means currently, in the current status, it's not an ordinary shares. Maybe it's a bank loan, which in future will be converted to ordinary shares. Maybe it's a preference share, which in future will be converted to ordinary shares. So in that case, before it's converted, it becomes potential ordinary shares. So it will be converted into ordinary shares in future. And then we gave examples of potential ordinary shares. We gave examples of convertible debts, convertible preference shares, share warrants, share options, share rights, employee stock purchase plans, and contractual rights to purchase shares. We defined dilution, which will be our focus of today's session. We said a dilution is a reduction in EPS or an increase in loss per share resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or that ordinary shares are issued upon satisfaction of certain conditions. So when we talk of the terminology to dilute something is to reduce the concentration. So in this case, we have our EPS. Now, if we reduce the value of EPS, in that case, we talk of dilution. Dilution must result, if it's earnings, earnings come down. If it's a loss, losses rise. In that case, we talk of dilution. To dilute something is to reduce the concentration. So in the context of EPS, diluted EPS is basically where the EPS is brought down, or if it's a loss, the loss is increased. And what causes this bringing down of the EPS or increasing the loss? It's as a result of convertible instruments being converted, options or warrants being exercised, or new shares are issued upon satisfaction of certain conditions. Now, the opposite of dilution is anti-dilution. So if dilution is a reduction in EPS, anti-dilution will be an increase in EPS. If dilution is an increase in loss per share, anti-dilution will be decrease in loss per share. The other terms remain the same. So dilution, a reduction in EPS or an increase in loss per share, resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or that new ordinary shares are issued upon satisfaction of certain conditions. On the other hand, anti-dilution, which is the opposite of dilution, is an increase in earnings per share or a reduction in loss per share, resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or that new shares are issued upon ordinary shares are issued upon satisfaction of certain conditions. So in the last session, we also looked at the scope of IAS 32, which we divide IAS 33, sorry. We looked at basic EPS and diluted EPS. And under that, we saw that basic EPS is profit attributable to ordinary shareholders divided by weighted average ordinary shares. We say that when we want to calculate the basic EPS, it's calculated under the following conditions. Number one, if shares are issued at full market price, that is, we issue new shares at full market price, it will enable us calculate basic EPS. Number two, if there is what we call bonus issue of shares, or what is called capitalized. Bonus is also known as capitalization issue, or it's also known as scrip issue. So it can also enable us to calculate the basic EPS. And number three, rights issue of shares. So when we want to calculate basic EPS, we must check the question and find out, did we have new shares issued at full market price? That is number one. Did we have any bonus shares issued? Remember, bonus shares issue is issue of new shares to the existing shareholders for free, of course, in proportion to their current shares. In a rights issue of shares, it's issue of new shares to the current shareholders in proportion to their current shares at a price below the market price, but above the nominal price. So whenever you want to calculate the basic EPS, we said, number one, you check whether there is issue of shares at full market price. Number two, there is bonus issue of shares. And number three, there is rights issue of shares. So that's summary of the previous session. So let's go to today's session, which is on diluted EPS. We have defined diluted EPS as a decrease in earnings per share or an increase in loss per share, resulting from the assumption that convertible instruments are converted, options or warrants are exercised, or new shares are issued upon satisfaction of certain conditions. So in our today's session, let's start with diluted EPS. So we are saying in this case, equity share capital may change in the future owing to circumstances which exist now. So in this case, we are trying to say our proportion of ordinary shares maybe in 2 years' time may change due to decisions that were made today, circumstances that happen today. Now, this is what is called dilution. The provision of a diluted EPS attempts to alert shareholders to the potential impact on EPS. So we are just trying to alert the investors or the shareholders that if we convert the current potential ordinary shares into ordinary shares, what will be the impact, what will be the effect on the EPS in future? That is basically the objective of finding the diluted EPS, to look at the effect or the impact of potential ordinary shares on our earnings per share in the future. Now, what are some of the factors that can cause dilution? There are three major factors that can result into dilution. Number one, the conversion terms of convertible bonds. So if we have convertible bonds, which we agreed in the previous session that convertible bonds are potential ordinary shares, if we convert these bonds into ordinary shares, it results into dilution. Number two, conversion terms of preference shares. So if preference shares in future will be converted into ordinary shares, in that case, it will result into dilution. And number three, the exercise price for options or warrants. So if we exercise an option or a warrant, in this case, it also results into dilution. So there are three major factors that cause dilution, that results into dilution. Number one, convertible terms for convertible bonds. Number two, conversion terms for convertible preference shares. And number three, the excess price for options or warrants. Now, number one and number two, that is convertible bonds, and number two, convertible preference shares, their accounting treatment is the same. So the example we'll focus on, the same example can be applied to either convertible bonds or it can be applied to convertible preference shares. However, the accounting treatment for exercise price for options will be different. So to enable us cover these into much details, we'll focus on two examples. Example one will be an example that will enable us know how to account for convertible bonds. And example two will enable us know how to account for options or warrants if they have been exercised. Now, in calculating the diluted EPS, that is, I'll abbreviate it as DIPS. In order to calculate the diluted EPS, the formula is earnings plus notional extra earnings divided by number of shares plus notional extra shares. Now, earnings in this case is just the profit after tax minus preference dividends. The same way we calculated it under basic EPS. So when we talk of earnings in this case, it's basically profit after tax minus preference dividends, or in basic EPS, we call it profit attributable to ordinary shareholders. But we have added in diluted EPS notional extra earnings. So what is notional extra earnings? These are the extra earnings, the additional earnings we'll receive as a result of conversion of potential ordinary shares to ordinary shares. Let me give an example. If we convert loans into ordinary shares, we will be saving on the interest we were paying on the loan. So when we convert the loan into ordinary shares, previously, when we were paying the loan, we were paying interest. So when we convert the loan into ordinary shares, we will stop paying interest, of course, net of tax. We will stop paying interest that we used to pay on the loan. So there will be a savings on interest when the loans are converted to ordinary shares. Now, this savings on interest, net of tax, is an example of notional extra earnings. Now, when we convert the loan into ordinary shares, it means there will be new shares. These extra shares as a result of conversion of the loan into ordinary shares is what we call notional extra shares. So in diluted EPS, you must note that there is notional extra earnings, the savings on interest, that was an example, and there is also notional extra shares. Now, in our first item, convertible bonds and preference shares, we have said the accounting treatment of convertible bonds and preference shares is the same. So the basic principle of convertible bonds and convertible preference shares are similar and will be dealt with together. So when we are going to cover it, we'll be covering them together. If the convertible bonds shares had been converted, so what I've just explained previously, the interest or dividends would be saved. So when I convert the loan into ordinary shares, I'll be saving on the interest. I've already explained that. And also, when I convert the loan into ordinary shares, the number of shares will increase. Let's look at an example of convertible bonds and ordinary shares. So the question reads, on 1st April 2001, a company issued 1,250,000 8% convertible and secured bonds for cash at par. So on 1st April 2001, this company issued a loan or a convertible bond, and the value of the convertible bond was 1,250,000, and the interest, of course, on the bond was 8%. Each $100 nominal of the loan stock will be convertible between the year 2006 and 2009 into a number of ordinary shares. What do we mean by that? For this 1,250,000, it is divided into $100 each. So we are being told for every $100 of the loan stock or convertible bond, for every $100, it will be converted into ordinary shares as follows. By 31st December 2006, it will be converted into 124 shares. For every 100 loan, we will convert every 100 loan into 124 shares. In 2007, we'll convert it to 120 shares for every 100. In 2008, we will convert it into 115. In 2009, we will convert it to 110. Now, the rule when you've been provided different rates of conversion, the rule is to choose the highest. So which is the highest? Because, of course, we will benefit as the loan holders will benefit if we pick the highest option. So the best option in this case for the loan holder, the issuer of the loan, is to have $100 at 124 exchange rate. So up to the year 2005, 2005 is before 2006. Up to the year 2005, the maximum number of shares issuable after the end of the financial year will be at a rate of 124 shares per $100 on the 1,250,000 debt. So anytime before 2006, the rate of issue will be, for every 100, will be issuing 124 shares, which translates to 1,550,000. So how do we get the 1,550,000? It is basically the amount of the bond. You multiply by 124, you divide by 100 to get the number of shares. I'm repeating, the loan is 1,250,000, and you are being told for every 100 loan, we are receiving 124 shares. So if you want to know the number of shares as a result of the conversion, it will be this loan of 1,250,000 times 124 divided by 100. Let's continue reading. With 4 million already in issue. In other words, we already have 4 million shares. But remember, we are introducing 1,550,000 shares. So with 4 million already in issue, the total becomes 5,550,000. So 5,550,000 is 4 million plus 1,550,000. It is the maximum possible number of shares that can be converted into which is always used. So the maximum, as I had explained earlier, so this is the maximum, is which will always be used. So we have some relevant information. Issued share capital was $500,000 in 10% cumulative irredeemable preference shares of $1. 1 million in ordinary shares of 25 cents each. Remember, 100 cents is equal to $1. So the ordinary shares, the value was 1 million, and the value of each share was 25 cents, which gives you a total of 4 million shares, which we had earlier seen here. So income tax rate is 30%. Trading result for the year ended 31st December were as follows. Remember, the date was 1st April 2001. A company issued 1,250,000 loan or the bond. So for the years ended 31st December 2002, we've been given the profit before interest and tax. We have been given the interest on 8% convertible unsecured bonds. We've been given profit before tax. We've been given income tax and profit after tax. Required basic EPS for the year ended 2002 and its comparative figures. And number 2, calculate the diluted EPS for the year ended 2002 and its comparative figure. So let's go and attempt this question through maybe Excel. Okay, so we have the same question in our screen here. So the same question, I'll not need to read it again. Let's just go to the required. So required was calculate the basic EPS. And number 2 for the year 2002 and its comparative figure. And number 2, calculate the diluted EPS. Calculate the diluted EPS. And remember, this is an example of convertible bonds and preference shares. So in our solution in this case, remember our topic is diluted EPS, diluted earnings per share, EPS. And here we are looking at how to account for convertible bonds and preference shares. The same way we convert the bonds is the same way we account for preference shares. Now we have said, to start us off, we have said that diluted EPS is equals to, we have seen it's equals to earnings plus notional extra earnings. And then we said you divide by number of shares plus notional extra shares plus notional extra shares plus notional extra shares. So remember, the question is asking you, number one, calculate the basic EPS. Number two, calculate the diluted EPS. So let's not lose focus on that. Number one was calculate the basic EPS. Number two, calculate the diluted EPS. So let's look at the question. First of all, sometimes you are not given the number of shares converted. So if you have not been given the number of shares, we said you check the highest rate. So we are being told for every 100 loan or for every 100 bond, every 100 is converted into 124 shares. So it's important, it's prudent, first of all, to get the number of new shares, or what we call notional extra shares. Now, in order to get the notional extra shares, or that number of new shares, we have said you will take the amount of the loan. The loan was 1,250,000. And then we have said you multiply by the new number of shares, the rate, divide by the loan. In other words, for every 100 loan, we were getting 124 shares. So if I want to get the number of shares, that is the accounting treatment that I give out. So it is, let me type it. It is, let me re-explain it. It is 1,250,000 times 124 divided by, so that gives you the number of shares. So what will be our number of shares? It is 1,250,000. And then we have said you multiply by 124, and then you divide by 100. So what does it give you? The 1 million. Okay. So it gives you the 1,550,000 shares. However, this was provided in the question. That was provided in the question. So what is the total number of shares? Total number of shares. Number of shares will now be equals to the current shares of 4 million plus the new shares as a result of conversion, 1,550,000. So the total number of shares will be equals to the 4 million plus the 1 million. So that will give you 5,550,000 shares. So that is the total number of shares. Now, in order to calculate the diluted EPS or even the basic EPS, we said you need to find the profit attributable to ordinary shareholders. In short, profit after tax minus preference dividends. Profit after tax minus preference dividends. So that is what I want us to next look at. How do we calculate the profit after tax less preference dividends? So we want to finding profit after tax less preference dividends. In bracket, profit attributable to ordinary shareholders. So that is what we want to find in this context, finding the profit after tax. So how do you find this profit? Maybe let me use a different color to highlight that. So finding the profit. So in order to get, remember we had 2 years. Here we have profit after tax. Profit after tax. So we need to get profit after tax minus preference dividends. So we will need to get for the year 2000 the first year 2002, the year 2002, and we'll also need to find for the year 2001. Now, what is profit after tax? Our profit after tax in this question, our profit after tax, we can see it here, 700,000 and 641,000. So let's have it. 700,000 is the profit after tax in 2002. And in 2001, it is 641,773. 641,773. Remember, the profit that is used to calculate the earnings per share or diluted earnings per share is not profit after tax. It is profit after tax. You less preference dividends. You less preference dividends. You less preference dividends. Now, how do we get preference dividends? We need to know what is the preference shares. You are being told here the 500,000 in 10% cumulative irredeemable preference shares. Now, in this case, we are trying to say, in this case, the value of the preference shares is 500,000 and the rate of dividends is 10%. So what is the preference dividends? It will basically be 10% times the preference shares value. So the preference shares value is 500,000. So that is what we'll have. So our preference dividends, if I bring it here, it will be 10% times 500,000. And this other side, it will be 10% times 500,000 also per year, of course. So our preference dividends, we have found to be 50,000, 50,000. So what will be our profit after tax? Profit after tax less preference dividends. Profit after tax less preference dividends. So our profit, in other words, profit attributable, it will be 700,000 minus 50,000, which gives you 650, and this also the same, minus 50,000. So that is the earnings. This is now the equivalent of earnings, 650 and 591. So we have found the profit after tax less preference dividends, which is also known as profit attributable to ordinary shares, which is also our earnings, Now, before we move on, this is number one. I wanted to find number one. I wanted to find basic EPS, basic earnings per share. Now, basic earnings per share. That was the number one item I wanted to find. How do we get the basic earnings per share? So that is what we have seen. Okay, now that is profit. But we also, that is profit. Number of shares, remember, has not changed. We only change to these if we want to calculate, please get me right, if we want to calculate the diluted EPS. But when I want to get the number of shares, the number of shares still remain the same, 4 million. And also here, it is 4 million. It only changed because of the dilutive factors. It only changed because of the potential ordinary shares. But when calculating basic, you don't use the potential ordinary shares. So our basic EPS will therefore be equals to, it will be equals to 650 divided by 4 million and this other side, it will be equals to 591 divided by 4, divided by 4 million. So we can be in a position to get the basic EPS in each year. So in this case, the basic EPS is 650,000 divided by 4 million. Okay. And this other side is equals to 591 divided by 4 million, 0.15. Or maybe I can even raise it to 3 decimal places. So 0.163 and 0. And remember, this is dollars per share. Dollars per share. Dollars per share. 0.163 and 0.148. So remember the years. So this is for the year 2002 and this is for the year 2001. So maybe let me just repost the years just for the sake of affirmation. Or I can just leave it. So that is how we calculate the basic EPS. Basic EPS. So we have found the basic EPS. So number 2, we can now go and find the diluted EPS. Diluted EPS. Earnings per share. Diluted earnings per share. Now, remember we have said diluted earnings per share, it is this. Remember we have said it is that. Earnings plus, so copy, let me just redo it. Okay, now we already have the notional extra shares. And remember, the notional extra shares were raised in the year 2001, not in the year 2002. So in this case, we need to start with earnings plus notional extra earnings. Earnings plus notional extra earnings. Our earnings will be equals to, where is earnings? 650. And this other side, it will be equals to 591. Our notional extra earnings will be equals to, we used to pay, please, we said notional extra earnings are the savings on the interest on the bonds, net of tax. Now, what was the interest we used to pay on the bonds? 100,000 and 75,000. 100,000 and 75,000. So our notional extra earnings, check on this, it will be 100,000, which is the interest, but net of tax. If we remove tax, we remain with 70%. So it will be 70,000. I'm repeating. Notional extra earnings is the savings on the interest when the bonds are converted into ordinary shares. And in this 2001, it is 75,000. So 75,000 times 70%. 70% is you remove tax. It is net of tax. So remember, it is net of tax, net of tax. So maybe I can have a working one. So I can have a working somewhere to show that. So what is our adjusted earnings? The denominator. So what is our earnings plus notional and extra earnings? Earnings plus notional extra earnings. So our earnings plus notional extra earnings is 650 plus 70. And this other side, it is 591 plus 52. So that is the denominator. Okay, that is the denominator. Now, diluted EPS, okay, so, and then now next we need to find the denominator. Remember, denominator is number of shares plus notional extra shares. Number of shares plus notional extra shares plus notional extra shares. So maybe before that, we can get the diluted EPS in 2002. Diluted EPS in 2002. Diluted EPS in 2002. So that we move systematically. Now, diluted EPS in 2002, it will be 720. In 2002, remember, conversion was in 2001. Divide by 550. So what is diluted EPS? Remember, this is number of shares. Remember, this is profit plus notional extra earnings. That is earnings plus notional extra earnings, and this is the total number of shares after the conversion. So what will we get? The answer that we will get is 720 divided by that. It gives you $1.3 per share. Remember, it is diluted, so it should be less. It should be less than the basic. Basic was 0.163. Diluted is 0.130. That is diluted EPS. Diluted EPS in 2002. Now, in 2001, in 2000, diluted EPS in 2001. Now, remember, in 2001 is when this conversion option, on 1st April 2001, a company issued 1,250,000 bonds, and it was issued on 1st April 2001. It was issued in the middle of the year. The issue of the bonds was on the 1st April 2001, which is during the year. Let's take note of that. Therefore, we need to calculate weighted average number of shares. The same way we were calculating the weighted average number of shares, the same way we were calculating the weighted average number of shares in basic EPS. So if I return you back to basic EPS, there was something like this to calculate the weighted average number of shares. How are we calculating the weighted average number of shares? We were looking at the period, how many shares we have then, and then add new shares, and then at the end of the year, what do we have as the number of shares? So let's go to our question and finalize it. So we need to find now the weighted average number of shares in 2001. Sorry, that is in 2001. Remember, the issue date was 1st April 2001. So beginning of the year, so I'll have something like that. I'll have maybe beginning of the year was 1st Jan 2001 to just before the issue on 1st April to 31st March 2001. How many shares did we have before the issue? We had 4 million shares. We had 4 million shares. And this period is a period of how many months? 3/12 months. 3/12 months. So what will be the weight? The weight will be 4 million times the period is 3/12. So that will give you a weighted average of 1 million. And then on 1st April 2001, we introduced, there was conversion. And how many shares were converted? There was 1st April, there is potential ordinary shares. Let me call it potential ordinary shares. So the potential ordinary shares will be equals to, potential ordinary shares will be equal to, we had calculated it earlier. Yes, to 1,550,000. 1,550,000. 1,550,000. 1,550,000 shares. Let me go back to this. So what is now the total after that date? The total after that date will be equals to 4 million plus 1,550,000. So it will be 5,550,000 shares. And these 5,550,000 shares will run from 1st April 2001 to 31st December 2001. So these will serve how many months? The remaining months from 1st April to 31st December is 9/12 months. So that will give you 5 million times 9/12. It will give you 4,162,000. So what is now the weighted average? Weighted average number of shares will be equals to 1 million plus that after applying the weights to them. So this is the weighted average number of shares. Therefore, diluted EPS will be diluted EPS EPS in 2001 will be equals to the number of the profit, which is 644, divided by the weighted average number of shares, divided by weighted average number of shares. Remember, the weighted average is calculated in the year of issue. In the year of issue, which was 2001. In 2002, we don't calculate the weighted. In 2002, we don't calculate the weighted average number of shares because the shares were issued in the previous year. Shares were issued in the previous year. So we have the basic EPS, just a second. We have the basic EPS in 2001, in 2002, and we have the basic EPS in 2001. We have diluted EPS in 2002, and we have diluted EPS in 2001. And that is how we account for potential ordinary shares, and specifically how we account for convertible bonds, and preference shares. How we account for convertible bonds and preference shares. To enable us wind up on basic EPS, it's also important to wind up on diluted EPS. It's also important to look at exercise of options and warrants. Exercise of options and warrants. How do we exercise our options and how do we exercise our warrants? So we'll need to go back to our slides. Exercise of options and warrants. The accounting treatment is not as long as under bonds, convertible bonds and preference shares. Options is basically straightforward. So maybe in the next 10 minutes, we should be completing these. So options and warrants. An option or warrant gives the holder the right to buy shares at some time in the future. Remember, it gives the holder of that particular option the right to buy shares at some time in the future. Cash does not enter the entity at the time the option is exercised. Cash enters the entity. I'm sorry for that. Cash enters the entity at the time the option is exercised. In other words, when we exercise the option, the business will receive cash because you will be issuing ordinary shares when the option is exercised, and there will be cash that comes in. And diluted EPS calculations must provide for this extra cash that we get. So the total number of shares issued on the exercise of the option or warrant is split into two. So whenever option is exercised, in this case, the total number of shares is split into two, and this is very important. Number one, the number of shares that would have been issued if the cash received had been used to buy shares at fair value. Remember, for somebody to exercise an option, maybe if the market price of the shares was 1,000 per share, for somebody to exercise the option, you must exercise only if you will gain. So if the value will be slightly lower than 1,000 prevailing market price, you can exercise your option. But if the option rate is more than the market price, it doesn't make any sense to exercise the option. So you will only exercise if it's beneficial to take advantage of the option that you are given. When do you take advantage of the option you are given? If the market price of the share is higher, the current market price of the share is higher than the exercise price or the option price. So point number one is very important. The number of shares that would have been issued if the cash received had been used to buy shares at fair value. So you must divide the number of shares into two. The number of shares that would have been issued if the cash received had been used to buy shares at fair value. And number two, the remainder which are treated like a bonus issue. For example, if we were talking of market price being 1,000 and the option rate or the exercise price is maybe 800, it means for me to exercise the option, I'll be buying the shares at 800, the rate that I was offered. and other people who are buying at fair value or market price will be buying at 1,000. So as the issuer of the shares, I will lose as a company because I'm giving this option at 800. The person buying is buying at 800. So to him is benefiting, but me as the issuer of the shares, I'm losing. So that free rate is how much? 200 that I'm losing. So that is the remainder, which is treated like a bonus. A bonus because it's for free, as having been issued for no consideration, because we issued at 800 instead of issuing at the market price of 1,000. So the number of shares issued for no consideration, this is important. The number of shares issued for no consideration is added to the number of shares when calculating diluted EPS. I'm repeating, in options and warrants, there is the current number of shares. And then there are shares issued at no consideration. The shares issued for free. So you take the current number of shares, to it you add the shares issued for free. When you want to calculate diluted EPS, you take the current number of shares plus the shares issued for free. We will see how to find that. So we have an example that will enable us explain all that point. We have an example that will enable us explain all that. So we have on 1st January 2007, a company has 4 million ordinary shares in issue and issued options over another 1 million shares. So the current number of shares is 4 million, but there is 1 million extra shares to be issued through options. The net profit for the year is 500,000. During the year to 31st December 2007, the average fair value of one ordinary share was $3. So the market price, the fair value of one ordinary shares was $3. And the exercise price for the shares was 2. Now look at the option price. The option price is 2 and the market price is 3. So which means these potential ordinary shareholders will exercise the option because the option rate is lower than the market price. Therefore, they will gain, but the business will lose. Why will the business lose? Because there is one share that will be issued for free. So the market price is 3 and the and the option rate is 2. So if these people buy at 2, we will be losing 1 for every market price of 3, we'll be issuing it at 2. So we'll be losing 1. So the bonus 1 will be 1. So remember we said you get the weighted average. And when we are trying to get the weighted average, we are interested in number of shares plus the extra number of shares as a result of options issued for free. So what is the question asking you? Calculate the basic EPS and diluted EPS. Let's go to Excel and finalize this. So as we finalize this, let's look at diluted EPS, the question we have just read. Let me slightly increase the font size so that you can see. Okay. So remember we are in our solution still, so that we don't forget. In our solution, we want to look at diluted EPS, diluted EPS, but our subsection is exercise of options or warrants. Exercise of options or warrants. Exercise of options or warrants. Now, so I'll start with number 1, basic EPS, before I go to diluted. Basic EPS. So our basic EPS, of course, for the year 2007, that is obvious because it's only 1 year in this. question. So we need to start by calculating the basic EPS. So in order to get the basic EPS, remember it was profit attributable to ordinary shareholders divided by number of ordinary shares. So it will be the basic EPS will be the profit is 500,000. The profit is this 500,000. Profit is 500,000. And then I divide by the number of ordinary shares. Don't account for, when looking at basic, remember, you don't account for options and warrants. So the number of ordinary shares is how much? 4 million. 1, 2, 3, 1, 2, 3. So it's 4 million. So in this case, we'll be in a position to get the basic EPS, which is fairly straightforward. And this should be free marks. Okay, I mean easy marks, not free marks. So it's $0.12 per share. So that is the basic EPS. Now let's go to number 2, diluted EPS. That was basic. Number 2, we go to diluted EPS. Diluted EPS. And of course, in 2007, and here there is exercise of options or warrants. Let's be attentive as we wind up on this. Now, we need to find the ratio of the shares issued for free. Ratio of shares issued for free. Ratio, okay, ratio of shares issued for free. Or let me look for shares issued for free. So in order to get the shares issued for free, it will be equals to number of new shares, number of new shares. Please, this is the most important point here. Number of new shares times number of new shares times market price per share, that is the fair value, minus option rate. Remember the market price was 3. Option rate was 2 divided by market price per share. I will explain through example. Let's not worry about that. So we are trying to say the number of shares issued for free, it is the number of shares. Our number of shares is 1 million. Number of new shares, rather, it is 1 million. Okay. Times MPS is 3 minus 1 3 minus 1 divided by 3. So what do we get? So that will give you 1 million times 1/3. So it will give you 3. That is equals to 3 minus 1 is, 3 minus 2, not 1. This is 2, not 1. 2. So, okay. So this will give you 3 minus 2. It is not happening. Of course, I know where the problem is. I need to change something here. Okay. So 3 minus 2, 1. And this is just that 3. So 1 over 3. So that is how we got this. That's how we got that. Okay, so that is the number of shares issued for free. So the weighted average, look at this, weighted average number of shares weighted average number of shares will be equals to the current number of shares plus shares issued for free. We had already agreed on that. So current number of shares is 4 million plus shares issued for free is 333. So because all these shares, we were told they were issued at the beginning of the year. So we will not prorate with the number of months because everything was issued at the beginning of the year. So that will give you 4 million Yes, it will give you the 4 million plus 333. So it will give you 4,333,000. And finally, diluted EPS will therefore be equals to diluted EPS will therefore be equals to the profit divided by weighted average number of shares. Profit divided by weighted average number of shares. And that will give us 500,000 divided by 4 million. So that will give you 0.115 dollars per share. In conclusion, what are we trying to say? In diluted EPS, as we wind up, we are now summarizing. We say dilution, as we wind up on that. Dilution is decrease in EPS or an increase in EPS or an increase in loss per share, resulting from the assumption that the convertible instruments are converted, options or warrants are exercised, or new shares are issued upon satisfaction of certain conditions. And we say that the factors that contribute to dilution include, number 1, convertible bonds. Number 2, preference shares, convertible preference shares. And number 3, options or warrants. So if we exercise those, in that case, it results into dilution. Finally, what is the importance of diluted EPS? It shows what the current year EPS would be if the dilutive potential ordinary shares in issue had been converted. So it's a projection of the future. If we convert the potential ordinary shares, what will be the effect on earnings per share? Number 2, it can be used to assess the trends in past performance. Number 3, it serves as a warning to equity shareholders that the return on their investment may fall in future periods if potential ordinary shares are exercised. Now, finally, what are the limitations of earnings per share? It does not take into account inflation. Apparent growth in earnings may not be real. So sometimes there is growth, but the growth was just as a result of inflation, or the rate by which there was growth is less than the rate of inflation. So there is basically nothing you have earned as an increment. Number two, it is based on historic information and therefore does not necessarily have predictive value. This is also a limitation of ratios in general. They are based on historic what? Information. Limitation number three, an entity's earnings are affected by the choice of its accounting policies, which is true. The accounting policy that you choose affects the earnings, and therefore it may not always be appropriate to compare EPS of different companies because the policy that company A uses may be different from the policy that company B uses. And finally, diluted EPS is only an additional measure of past performance despite looking at future potential shares. So that is what we have in that case. And that brings us to the end of diluted EPS. So basically, we have covered EPS in 2 sessions. Make sure you follow the recording of session 1 or part 1, which was looking at basic EPS, and today's session was looking at diluted EPS. Thanks for your attendance. Let's meet for the next session.